Kia ora, everybody. Welcome, very warm welcome. I'm going to introduce and welcome Rob Flanagan, Chair of the Financial Services Council, to say a few words of introduction, and then we'll get the show underway. Rob, warm welcome, and over to you.
Thank you, Richard, and tēnā koutou, tēnā koutou, tēnā koutou. So, on behalf of the FSC Board, I'd like to welcome you all this morning to this presentation from the Reserve Bank. Appreciate we're all in lockdown, and this is the best medium, but certainly appreciate all the attendance. So thank you, and I'll hand over to Richard to do the introductions.
Thank you, Rob, and thank you. Echo Rob's welcome, and thanks for people for joining. A very warm welcome to the Reserve Bank team of Geoff Bascand, Andy Wood, Adrian Allett, Richard Dean, and I think Brendan Manning will be joining us. These sessions, for many of you, I know have seen before, have really been framed up as a connect on a regular basis, which really started in the eye of the COVID storm. Great opportunity for all of us in the sector to connect directly with the senior people in the Reserve Bank, understand their read on the market, on the economy, on the broader regional context, and also, of course, pick up any particular issues that are going on, reference, of course, the cyber breach discussion, which we'll have a little later. So the way we're going to run today is I'm going to invite and hand over to Geoff in a moment to run through a presentation for 15 to 20 minutes. Absolutely encourage everyone to use the chat bar, the question bar, and what we'll do after 20 minutes is we're going to come back into an open forum discussion. So we'll try and pick up as many of the questions as possible. So totally encourage that. Last thing to say, of course, we are on the record. This is being recorded and will be available post the event. So with that, to Geoff, to Richard, to Andy, to Adrian, and to Brendan, a really warm welcome. And Geoff, over to you.
Thanks very much, Richard, and greetings, kia ora to all the participants, and thank you for the opportunity to talk with you. As Richard said, I was planning to really run through how the Monetary Policy Committee Bank had been was viewing the economic outlook and our monetary policy settings, if you like, for the period ahead. It's actually got a fair bit of rear view mirror, because I think take on it, which is important for us. So I'll do that. I'm also going to say a few remarks at the end on the cyber breach, and of course we can take any questions on either of those topics or on any of the regulatory agenda if you wish as well. I've got my colleagues here to support me and assist in all of those regards. So right, okay, so just a sort of standard point of really less the point of a disclaimer than more the point of information for everybody. Of course, you know, we do operate a monetary policy committee these days. It's the formal decision-making mechanism, and so the views, you know, obviously are here representative of the committee as a whole. And you know, of course, we have some divergence of views at times in that committee. They're set out in the record of meeting, where different members have maybe been a bit more worried about certain risks or a bit more attention to certain developments. So, you know, this is a consensus view, and I think it's always just helpful to remind that there's no absolute purity or singularity of view or correctness of view. Next slide, please. Hey. The big picture, and I suppose, you know, a really interesting thing, the last monetary policy statement, of course, was back in November, and so a few months since then. And we entered this year knowing that the economy had been doing better, and really the big centerpiece of the discussion was how strong that recovery is, and how sustainable, how fast it would continue to be maintained at. I mean, I think, and I'll hit this point a few times with some slides. You know, it's very easy to forget how dark it was through much of last year in terms of the economic clouds, and and we all had all that discussion about whether we're going to have a V recovery, and then people thought, no, it's more likely at best a U, and it possibly even as an L, and all of that sort of discussion. Well, in the end, we did get a V, and I'll illustrate that in a moment. But having had a V, does it mean it keeps on going up like a rocket, or does it sort of start to level off? And it's accelerated quickly through the September quarter last year. People spent up. Activity got going again faster than we expected. I suppose when we looked at this, we still think that there's quite a lot of headwind and quite a lot of uncertainty in the world economy. I suppose the current lockdown actually just illustrates and demonstrates that sort of caution that we had. And the other, central plank to that scenario is that the recovery still remains very dependent upon the fiscal and monetary stimulus that's underpinning it. To assume that it can carry on without that stimulus is a very strong assumption, and not one that we would support. So what we really got was, look, it's fantastic. The economy's recovered more quickly and better than we thought, but we see a slow/uncertain path ahead, and one that still needs lots of monetary support would be the short story. So next picture, Hayley, please, and I'll just illustrate these points. So here you see the V. Obviously, it was a very severe recession. I mean, let's not forget we closed the economy and we had 14% drop in GDP in the June quarter, bounced back and strongly in the September quarter, and carried on with some modest growth, at least in the December and probably the start of this year, but we're not sure how strongly. What surprised us is we sort of got back to the level of GDP that we had before COVID by the end of the year, and we previously had thought it would take us until 2022 to do that. As I say, you can see from this chart, it's got a reasonably shallow path for the next 18 months, 2 years before it starts to accelerate again, and it's really the shape of that path that means that we think we still need a lot of monetary support. Next slide, please. Why did we get the bounce back and recover and have a much stronger story than we thought we were going to have? Well, there are a number of reasons to this, and they give insight into the picture looking ahead. For a start, New Zealand's health response, if you like, and management of the pandemic was much more successful than internationally, and of course more than we had assumed. When we were doing scenarios back in August last year, we were expecting to be at least in level 2 lockdown for a whole year, and we had long periods of level 3 as well. We came out of it more quickly through the tight mobility restrictions, and that certainly helped us get back to a freer form of activity in the September quarter and December quarter than we assumed, notwithstanding that we still did have another spell of Auckland's lockdown, of course, and have again had some this year. Next slide, please. Internationally, generally speaking, New Zealand suffers strongly when there's a world recession on. As, we're a trading nation dependent upon exports. Our prices are sort of respond to how much demand there is. What's been a bit extraordinary in this a recession, this event around the world, is actually our export demand has held up. Partly that's due to China recovering more quickly than was assumed. Sort of East Asia itself has just been a bit stronger, and so rather than having that big export shock, surprisingly, we've stayed. The export sector has supported the economy. This, of course, is on goods, not true on services, where tourism did take all the hit that we thought it would, and is still suffering. And I'll come back to that. But in general, on the goods side, dairy, forestry, meat and so forth have done, horticulture have all done much better than we anticipated. Next slide, please. But I think possibly that, absolutely the biggest story, I mean, there's a number of different stories going on here, but in a sense, what's surprised us more than anything is that fiscal policy really held the business and household sector together more effectively than anyone assumed. again, historically, fiscal policy usually works with a lag. It takes a while for government to spend the money for it to flow through to the economy. Well, the wage subsidy was extraordinarily effective. It did what we all hoped it would do, which was help businesses hold on to staff, to keep paying them, and to hold on long enough to get through the lockdown. It's associated with the lockdown being a bit shorter than we feared. Whether we could have kept the wage subsidy going for 9 months would be doubtful, but we kept it going for the period. And what you saw is the government taking on a lot of debt and household earnings and business earnings being better protected than expected. So we didn't get the massive increase in unemployment. We actually, again, looking at this chart here on labour income, it bounced back and it's actually grown over the year. It was quite surprising, really. We didn't expect labour income to grow. We expected it to fall quite sharply. Next slide, please. And here, this is just illustrating the fiscal transfer. It's a very, very large fiscal transfer. And we're truly one of the larger ones on the world scale, and a lot of it went out very, very quickly in 2021. This is debt, which is the accumulated part of the fiscal spend. That keeps rising. There is more coming, but it's just not coming at as fast a rate as we had in the last few years. Next slide, please. Of course, monetary policy did its part. We cut interest rates very significantly, did, as you know, all the asset purchases and later on the funding for lending programs. So, supporting cash flow of businesses and households. And then, of course, a number of regulatory initiatives to support it. But by the end of the year, we were needing to tighten them to slow down the housing market. And we can come back to that later. Next slide, please. The other part that's going on is trying to track population and growth. And migration data is a little hard these days. It comes with a much bigger lag to be accurate than it used to. And but nevertheless, the current assessment is that we ended up with quite a large inflow of returning Kiwis through last year. And, this contributed to the housing market. It contributed to holding up spending. And so whereas we'd probably thought that, closed borders, flat, no immigration, no tourism, but also flat population growth, we actually did get, we think, quite reasonable population growth through last year. This is again plays a bit into the dynamics as we tend to look forward. What you find is that some of these things are finishing. We think that population growth is basically pretty much finished in a net sense now, and now we're paying the price a little bit of the summer season when we would get a lot of tourists coming in. We're not getting them. So I'll talk about that slightly later. You can see the big resurgence in house prices. Sorry, yeah, next slide onto the tale of the two economies. So the last point I want to make before I look ahead is just that, let's remember that the economic recovery has still been very uneven. Services sector has been hit hard. Here you see it, transport, postal, professional services showing quite big falls in activity. On the other hand, the construction and retail trade sectors have done well. So a mixed story, and you can see it, next slide please, Hayley, again in the employment story where that sort of mirrors the output. Government sectors actually employed quite a lot more in MIQ facilities and wherever else, I suppose, and construction, but services have lost people. And so while it's a good story overall, it's not a story where the whole economy is running on 4 cylinders. It's sort of running on 3 cylinders is probably a better description. That's the segue to the looking ahead. Next slide, please. So when against that backdrop, trying to understand what's going on, when we thought about how does it play out for the next couple of years, the scenario is one of uncertainty still elevated around pandemic, still around rolling quite seriously around the world. Vaccination's going on, which is fantastic, but world vaccination rates are a few percent of population, much higher in the UK, but still a long way below immunity rates. Most of the world has still got quite low rates, and it's going to take quite a while. As I said, we've got this question: well, how fast do you come out of this carry on this recovery? We're going to have less fiscal stimulus than we've had, but less population growth, and we've got continued uncertainty. Next slide, please. All of this leads to business investment being uncertain, and so you're seeing weak lending to businesses. Businesses are, generally speaking, pleased to have activity, and in some sectors doing well, but they're not sort of plunging into investment with that confidence that the world ahead looks great. So that moderates growth. Next slide, please. We're changing our working habits and practices. Vacancy rates in office space and retail are up, so one would expect that beyond the pipeline of work that's already underway, pipeline of commercial construction's a bit doubtful. Next slide, please. You're already seeing consumers, they had a big bounce in spending, but if you look at the more recent data, it's been quite modest. And so that, generally speaking, that black line, if you like, card spending through the end of the start of this year has been quite low. So, I'm not saying households are completely tightened up and got scared, but they're not splurging. So it's more supportive of a slow growth story than a fast growth story. Next slide, please. What does all that mean? Well, generally speaking, it means we think it's going to take a while to get core or underlying inflation back up to where we need it. There's a bit of a funny story about inflation. It'll actually spike quite a bit in this coming year because we've had oil prices rising, and so you get a bit of a lift. That's not unhelpful from inflation expectations, but we don't think it's going to be seriously baked into the future. We think, generally speaking, the softer forces will mean that inflation will subside a bit through 2022. And this is a story where we think we still need to support the economy to keep enough wind in the sails for it to get to target. Next slide, please. Let me just finish with the housing story, because I know this is obviously of interest and it's important. Clearly, the housing market bounced back much more strongly than we expected. There were scenarios rather than forecasts. We and most commentators had been expecting some decline in house prices in the face of low migration and low unemployment. High unemployment. Whereas we got low unemployment and high migration, and of course the effects of low interest rates and more confidence and everything else, and the housing market took off. Government concerned about that and legitimately has a policy interest in housing being there to be affordable for both renters and home buyers. So the government has, of course, the Minister of Finance exchanged a series of letters with us just before Christmas, and then just Thursday last week issued a direction to us, which is under a provision in our legislation that relates to our financial stability responsibilities, that we should have regard to the government policy to support more sustainable house prices. If you read the whole words, including by dampening investor demand for existing housing stock, which would improve affordability for first home buyers. I want to be very clear here. This is it's a legal direction, but it relates to, it says we must have regard to house prices in relation to our financial stability mandate or objectives. It doesn't change our monetary policy objectives. They are still inflation and maximum sustainable employment. The government did say that when we make a monetary policy decision, we need to assess the effects of our monetary policy decisions on the government's policy for sustainable house prices. So we're going to have to explain what we think the impact is, and we already had a responsibility to have regard to financial stability. So in a sense, it's just heightening that of saying, when you make the decision, have a look at what the impact is on financial stability and on sustainable house prices. Where this may have effect and an impact is it will basically encourages us to upweight house prices when we look at our financial stability policies, our LVR policies, any other instruments that we might want to use, debt to income instruments, or potentially sectoral capital overlays or whatever else. So I guess we can talk more about this when we do the financial stability report. But I just want to be clear, it's really directed there, making sure house prices don't go so far that they're at risk of blowing up, and they wouldn't be sustainable if you're got a very sharp or likelihood of a sharp correction. I'll flick to the next slide, please, Hayley, but I'll stop talking, I think. Just this is really just a wrap to say that story was, as I said, of one of a stronger recovery, but with some uncertainty about how strongly it will be sustained. I still think there's uncertainty there, quite a lot of drag from the weakness in tourism and education and so forth, and that need to support the economy looking forward. So, in big picture terms, it's a good story, but it's not a story which says that we're about to stop raise interest rates or stop monetary policy stimulus. We're going to maintain that stimulus, and what we said in the statement is we expect to maintain it for a considerable period of time until we're really confident that inflation and employment are back right up to their target levels. We don't want to do it just on when we think they might get there. We want to do it when we are confident that they're sustainably there. And what that means is we're going to be looking at underlying inflation and making sure that employment has not just got a temporary blip in it, but there's real full employment there from a number of dimensions. And so we think that'll take quite a period of time. Let me stop and we can take questions. Sorry, let me just finish a couple of remarks on cyber as you're preparing your questions. Okay, as we've said before, it's a deeply disturbing and breach that we're a victim of, along with many other users of the software. We apologise unreservedly to all of our clients that use that software with us, and that we've disrupted and harmed in terms of their clients, customers, and data management. Everybody who's had files downloaded has been notified of that, and that the data that was downloaded now, all of the personal or privacy related information has been communicated to those entities, and are in a process of communicating that to the individuals in conjunction with ID Care, a specialist privacy provider. So hopefully that's all in a process of remediation, if you like, now of dealing with the specifics information that it's been breached. And at the same time, of course, we are continuing our investigations of independent review by KPMG of how this occurred and what lessons we can draw from it in terms of our data and information management. And of course the forensics and criminal investigation that's ongoing about the perpetrator. And then of course we're still working on trying to develop robust ongoing processes for transferring information between institutions and us, because we do need to do that securely and in good volume, as you know. So those streams of work are continuing, but we trust that in a sense the breach management is now into a sort of a individual sort of case remediation situation, and the big part of the workload to do that sort of set up and underway. Happy to take questions on this or the outlook in due course. So thank you very much for listening to me, and turn over to questions, Richard.
Fantastic. Thank you, Geoff. Amazing to think 12 months on how the picture has evolved. I guess my first question is, and thanks for the questions that are coming through, I guess my first question is, Well, we are sitting now at the front end of 2021. As you said, vaccines and rollouts locally and globally are starting to play out. What kind of surprised you most about what happened last year and how we responded and how resilient it seems that New Zealand has been through, arguably some of the darkest days we've all experienced?
Well, I mean, I think I touched on the sort of the factors that we were thinking about. I mean, if I really pointed to one that surprised me most, it's probably the effectiveness of the wage subsidy. The fact that unemployment didn't rise as severely as we expected. I mean, you get a huge shock to GDP like we did get, close the economy for, 4 or 6 weeks and shut businesses down, and we knew that they were already going to suffer from no revenue, not being able to undertake things. We thought they'd have to lay off a lot more staff than we saw laid off, and we thought that would have a negative dynamic. As when unemployment rises, households get under a lot of stress. That flows on to not spending, and that flows on to a negative dynamic for other sectors in the economy, and it just becomes very ugly. I mean, I'm old enough to remember the '91 recession very whatever the emotive term is, it was a very, very painful and extraordinarily dark recession that we had then when we got up to 11% unemployment. We sort of thought all the dynamics then were what we sort of anticipated, but just didn't see. And I think in many ways it's a success that the government got money into the hands of businesses who then paid it out to workers and had it there and kept their cash flow going. They could pay creditors, they could do what they needed to do just to stay alive and hold on to that labour. And so when the economy came out of the lockdown, they could pick it up again quite quickly. And so, one doesn't want to overemphasise one single factor, but I think that was a pretty big surprise. It just doesn't normally happen.
It's interesting that you point to the balance sheets of New Zealanders and how resilient they were. The FSC last year tracked what we called the Financial Resilience Index, and at the start of the pandemic, there was huge concern about job security, as you correctly said, underpinning the rest of a family's balance sheet, if you will. But it remained remarkably resilient. It took an initial drop, but as you say, as we tracked it through, it was remarkably resilient. And we're sitting here, it almost feels like we're on the cusp of the roaring 20s. Is that something that you think might unleash globally as all of the stimulus comes through, as the pandemic kind of recedes, as the vaccines take up, that there's going to be this, live for today, spend for today, because hell, who knows what's around the corner?
I guess there's a bit of a debate going on internationally about that. I mean, there's the US fiscal stimulus is getting, very, very large now, which is relatively late in the piece. I mean, ours was huge last year, right at the height of the recession. Theirs is coming a bit later. I mean, go back through economic history, there is a bit of a story of government spending as being more pro-cyclical than counter-cyclical. It tends to come a bit late just when you don't need it. That's why we all used to get quite cautionary about fiscal policy being a demand management tool, and monetary policy became better accepted as a means to support an economy through its business cycles. Here, we've had a counter-example. It seems to work really well in New Zealand, as I said. Households are still saving more. I mean, it's interesting. I mean, there is more spending, but there's still savings rates have been rising around the world. They're very strong in Australia. They're very strong here. So, what you've seen is a big transfer of liabilities onto the government's balance sheet. The business, we actually did some work, and if you look at the hole in the business revenue, it was almost exactly matched by the increase in government debt. It was like a transfer from one sector to the other, and but that doesn't mean that they're certain that their profits and their revenue growth in front of them, or households that their wage growth in front of them will be so strong they can splurge. It just means that they're not suffering. We still think they'll be cautious, and as I said, investment somewhat, weak because of the uncertainty ahead. You still can't go over and do market development. You can't go strike new partnerships very easily around the world. You're not sure how big your export growth for goods would really be in a volume sense. You're maintaining existing relationships, but not, and working them well, but it's not expansionary. Households' wages aren't rising rapidly. They're staying okay. So it's a possibility. You never rule out possibilities. There's a scenario there where it could get a positive dynamic, but I think our more central scenario is one of more modest, cautious growth.
Thank you, Geoff. There's a bunch of great questions which I'm going to go to in just a jiffy. Just a quick one. You mentioned in your presentation around there are, if you will, winners and losers. There are sectors that are going really well and others that are really struggling. And obviously you cite the tourism sector. Is it really a factor of we've got to wait until the borders are open before we start to see that sector recovering, notwithstanding the domestic tourism that kind of carried us through Christmas?
I think to get back to the scale that it was operating at before, certainly it needs borders open. I guess the messages that we've received from talking with the business sector and financial institutions leaning into it is that domestic tourism did a good job through the winter of last year, sort of replacing, or winter/spring, replacing the foreign tourists. But our really, really big tourist flow period is the summer, and domestic tourists did not fill that hole. There's no way that they matched up to the million or so tourists we normally get coming in through the summer months. So this is a harder time. It's sort of and I think that's got some months to pay out. Still see New Zealanders, if they can't tour overseas, probably still doing some more domestic activity, but it's just not the same. So yeah, that remains a drag of 2 to 5% of total GDP. Sort of, that's not there. Then you so it's quick. Then do those workers find other jobs in other sectors and horticulture or construction or retrain or do things? Some of those businesses will just have to reinvest in other activity. I'm sure there'll be some great creativity to reorient some of it, but I don't think it won't be all replaced. Some of it's going to be just lost, I'm afraid.
There's a great question I'll come to just on the tech and the fintech space, but there's a great question from John just in relation to the house price changes in your remit. Will that adversely impact first home buyers in terms of making it more difficult for them to access the market?
Well, the government's directive asks us to consider whether we can focus, if you like, on investors to try and avoid it being overly restrictive on first home buyers. It still has to be within our financial stability mandate, so we have to make sure that we're doing it for good financial stability purposes. So maybe there's a little bit of looking very carefully at what the relative risk between those categories of buyers are. We've said before, we think investors are more risky at the margin than first home buyers, but it's not like one's totally risky and the other's got no risk. It's a somewhat riskier, and that's because investors can walk away. They tend to, first home buyers going to do everything they can to hold on to their house and service it and restructure it and whatever else. But at the same time, if they take on too much debt and they lose their job, the debts, they can't service the loan. There is risk there, risk to the household, risk to the banks, and so forth. We've got about 40% of first home buyers who borrow with less than a 20% deposit. They haven't got a lot of equity in their home if prices fall by 10-15%. So yeah, there's a bit of a bias there towards the investors we've been asked to look at, and of course that's what we've done in the last set of LVRs. We've put them on for everybody, but then we're tightening them further for investors from the 1st of May, so they will need a 40% deposit, whereas first home buyers will only need a 20% or less if the banks accommodate them.
Thanks, Geoff. There's a great question here just on extending that thought further, just on negative interest rates. It felt like the sector was almost put on notice to get ready for negative interest rates and what that ultimately meant for portfolios and so on. Just if you, any comments on outlook? Has that moment now come and gone, or is that something that we should still be prepared for? And what kind of action do you expect the sector to scenario planning, I guess?
Well, I don't think it's come and gone. I think it is. We're very pleased that we are prepared. So all the banks have signed off and told us that they're ready and can adopt them if we need to, and we can do that ourselves. So it remains very much part of our, well, it's a live part of our toolkit that we could use if we need to. I mean, under our current scenario, we don't need to add further stimulus right now because we think the economy is recovering. We need to keep the stimulus going that we've got, so we don't need to take it negative. But if things turn down, if we ended up with another 4-week lockdown, or whatever, the world economy hurts us more than it has been, then all bets are off. So it was always be prepared in case we have to go negative. And the good news is we are now prepared, and we can if we need to. So, I would say stand ready, if I use that phrase. Don't stand expecting that it's happening next week, but will be there in our consideration of tools as necessary.
Just an extension on that question around tools and I guess things in the RB's armoury to drive and finesse the state of the housing market. Are there any other things that the bank's considering over and above what's already within your remit?
Well, we've asked the government, and they've now asked us to go back with further advice and some more detail, if you like, on proposals to have a debt to income or a serviceability tool, making sure that it's all very well having LVR that protects the bank if the house, somebody has to default, they get enough security in the house. But actually, you want to be worried about whether people can pay the mortgage as well. So we would like a serviceability tool if we could. There are other things that we potentially have got. We've always said that we don't think they're quite as effective, but we'll continue to look at them, which are sort of capital or risk weights or capital overlays on housing, which is possible. They're allowable under the MOU we have with the government. The government's asked us also to look at interest-only mortgages for investors, whether they're appropriate or not. So we need to consider that. The APRA, Australian Regulatory Authority, did actually restrict those for a period when they were having a housing boom a few years ago. So that's a possibility. And these things need to be carefully assessed and evaluated, but I don't think our toolkit's closed. I think there are a number of things we could use to manage financial stability risks if we need to.
Fantastic. There's a great question here on your point around the New Zealand economy kind of in many ways being shut, but some sectors really being creative and innovative. So the question is, what do you see as the role for the tech space, the fintech space, the startup space to really take advantage of the brand New Zealand that's really come out of COVID, but also kind of leveraging the smarts and the capabilities? Is there a sense that of the RB's either role in that or observations around that sector?
Yeah, that's a really good question, and it's one I'm not sure I've got a very good answer to. I think it's really important. I mean, innovation is the heart of long-term productivity and growth and dynamism, and I've said before, I think the banking sector. I gave a speech on the future of banking last year where I said I think it is going to get shaken up by fintech over time. It's got a particular model, and you can just see more and more innovation that could, hopefully, with open data, with people finding different ways to provide services. We're probably seeing that a little bit in the consumer lending market. Of course, that's not the dominant market like mortgages is, but yeah, look, the creativity of technologists and financial entrepreneurs is the heart of how you have a competitive, dynamic sector. What we want to do is make sure that we don't inhibit that, but at the same time we don't let risks arise that we're not alert to from just things disappearing into places that aren't getting, scrutiny or monitoring. So we want to make sure the same sort of rules or risk management applies in an outcome sense, however the service is provided. What we want is make sure its money's protected, depositors feel safe, lenders can trust who they're borrowing from, or borrowers can trust who who's lending to them, I suppose what I'm trying to say. So as long as we've got those things and conduct's good, absolutely, we welcome it. I don't know, Andy, or you want to add anything?
Thanks, Geoff. It is a tricky one. I mean, I think we all recognise the value of innovation, as you say. I'd be interested. I mean, I think it could be a good topic to have a broader conversation around, to be honest, because I was involved with FinTech New Zealand some years ago on this very topic. I'd be interested on where in the InsurTech space, how much progress has actually been made. The sector's insurance sector has got a lot of big players. The banking sector has even got a larger number of big players. It's more of a concentrated sector. So I think we've got a job to maintain stability and look after sound firms, but we recognise the importance of efficiency. We want that to come through. The conversation for quite a few years. I'm not sure whether we're seeing quite as much as we would have liked. And maybe a topic, Richard, we could focus on separately, because it would be really interesting, I think, to talk to your members about what they are seeing. We're probably not as super informed as we would want to be in the space, so maybe that's something for another day. I'd certainly be keen.
Yeah, thanks, Andy.
Yeah, echo that.
Just I might just an observation. We had before we went into lockdown 2021. We were able to have a fantastic breakfast with the FMA team, and I remember the question came to Rob Everett around the regulatory remit. Just picking, Geoff, up your conduct question or comment, and we were just the week after the GameStop issue that turned up, and with the pickup and the take up of New Zealanders on using technology to invest in platforms like Invest Now and Sharesies and Hatch and so on, and the use of social media where you can create communities to take kind of collective action, that can be a pretty scary scenario for regulators.
Yeah, it's if you get herd-like behaviour in anything, I mean, you'll worry about, is it being rational and well-informed, or effectively emotional and sort of, we sort of worried a bit about that in the housing market, the fear of missing out, sort of driving, riskier purchases at the end because you're just too scared that, you don't do it now, and you get closer and closer, beyond where it's like going to an auction and bidding way past you're starting, you set yourself as a limit. So, I think obviously FMA has got a much stronger responsibility in the conduct than we do, but we are joined in interest in this area, and markets are not always well behaved, and do get these sort of exuberant sort of periods, and so information transparency, warnings, cautions can be part of it, but also how do you get the best out of somebody taking another position, somebody, that's where competition comes in, that somebody can say, well, that's gone too far and I'm prepared to bet on the other side of it. You hope that's happening as well, and markets being sold down. So, I endorse Andy's remark. I think, it's a number of topics there would be good to chat through in workshop or other forum.
Fantastic. I'm going to go to COFA and the COFA agenda in a moment, but there's a question here, Geoff, around your point around net migration changes. And there's been a lot of anecdotal story, particularly in the dark winter of COVID, where anyone who could get in was trying to find a way either to get back if they were Kiwis, or to get in if they were well-to-do people living elsewhere. What's your sense in terms of projection to migration once borders reopen? Do you think that New Zealand's going to almost become this destination of choice, this kind of safe haven that people will look to flood into, so to speak?
Yeah, it's a really interesting question, and I think you can, sort of map a couple of possibilities out. One's that. The other is, of course, that there's a lot of people who have been dying to get overseas to see family, to maintain our relationships and contacts, and we all keen to have our travel experiences again. And the rest of the world's a big oyster, and lovely to see it. So you can see it going both ways. What surprised us is the people coming home. We thought they might come home for a period, but wouldn't regard themselves as having really, changed their mind to become resident in New Zealand. But it does look like more of them have decided that they would settle here. So I guess that gives a little bit of support to your hypothesis, that it, we're healthy. We've got a lot of great features as a democratically liberal and socially supportive country and community. Economy's doing well. Those things are all absolutely propitious for people wanting to be here and bring your children up and do all sorts of things. So yeah, we've got a lot of great attractors. But what we do know is we also depend upon interactions. You need human capital flowing both ways, or use that bit of jargon, but we need the skills from the rest of the world. We need the best of that, and we need New Zealanders to get experiences in the rest of the world for long-term success and growth. So I, productivity hat, I put my long-term growth hat on. I hope that we can keep those world interactions going. But yeah, we're a pretty attractive place, and overall you'd probably have a net demand to be in New Zealand. I would think that we're going to have a migration policy that supports good skilled people coming, and of course we'll be open to New Zealanders coming.
Geoff, just a quick question back to cyber breaches. The KPMG report, I think, is that due to be reported back at the end of March?
Correct.
Is that going to be made? Is that going to be released publicly? And will the bank kind of engage with sector around the key findings?
There will be a public release. Yes, absolutely. It's important that we're open and transparent about lessons and engagement with the sector about that. So yes, I can't tell you any details of the process for that, but certainly that commitment to being open and to finding a forum for feedback and discussion would be important. Absolutely, this is very much about how we manage our own data, but B, manage the data that we hold on behalf of institutions and the flows of data between us. So yeah, it's not just us. It's a conversation for the sector.
Yeah, I think from the FSC's point of view, that's a really valuable place to go, because yeah, cyber breaches, whilst it's impacted the RB, it's impacted us all, and it's not going away anytime soon. So the lessons learned, the sharing of information, I think where appropriate, absolutely support that. In terms of third-party vendors, more a technical point. Has the RB moved on from the previous vendor or tightened up the process, or is that going to come out of the KPMG report?
We've closed down the application, the third-party application. Sending an application, so it's not being utilised and shut, to outside, not connected to our systems. So in that sense, that's finished. In terms of where we go forward, we're talking with industry. We have been talking to some of the CISOs, some entities, security officers. We're talking to technologists and talking in a procurement sense, or what is out there and available that potentially could replace the system that we had. We certainly won't be using the same system, I can assure you of that. Yeah, we're in a process really of evaluation of what is suitable and viable. I mean, I don't want to sound discouraging, but it's surprisingly not as rich and deeper a field of good contenders as one might have thought and hoped. So that's why a lot of agencies were using this other software. As I say, you know, many parties were unfortunately breached, not just us. But we've got to find a solution that works for us all.
Thanks, Geoff. Just a quick one on COFA, mindful of 8:52 on the clock. The COFA agenda for 21, you know, if we look at the last 2 to 3 years, there's been a huge raft of change coming through for the sector. And obviously there's a bunch of consultations taking place right now with the RB. Just any comments on COFA around the alignment of the key oversight priorities as we head further into 21?
Well, it's a timely question. We've got a COFA meeting today.
Good.
So hope your members are encouraged by that. No, absolutely. We've got you know, FMA, MB, Treasury, Commerce Commission and ourselves are at senior management level meeting this afternoon, and that's one of the topics on the agenda. You know, we have a agenda as a mix of our longer term strategic endeavours to get an inclusive, dynamic, you know, financial sector, but we also have that discussion of what's on the regulatory, you know, policy agenda, and having that discussion with a view to also having that discussion with ministers, because clearly, you know, that you know, this is an important dialogue where ministers have expectations of you know, issues being addressed, merchant fees being one of the ones that's been added to the work agenda in recent times, still concern about director executive accountability, still under review, and as well as on top of course, the things that we're already working through in terms of COFI and use all the acronyms there, SLAB and so forth. So yeah, look, I'm very conscious it is a big agenda. I can't promise a magic wand. You know, I mean, I know you're not asking for that. What we can do is say that we're definitely talking and trying to be conscious of time frames and understand where the pinch points really are with the sector. And of course they do vary a bit. I mean, which also adds. Insurance sector's got, you know, a number of significant things in front of it. The banks have got, you know, others, some of them cross over and some of them don't. But yeah, that dialogue's really important, and we are giving it attention. So
yeah, great. And look, the message from the sector is exactly right. You know, a better aligned, broader reg change agenda allows us to focus as a sector on the important things as led by both government and COFA. And balancing that to make sure that we continue to serve and look after New Zealanders who've obviously come through a really tough time. And in terms of the outlook, obviously there's we're not over it yet. And that's probably my last question, if I can. Number one, appreciate you joining as you have and been so available over the last 12 months. If we're sitting here in 12 months' time, what's your sense of where we'll be as a country? As a region, as a sector?
Oh, I really hope that we've got some borders open in 12 months' time. Our assumptions, if I turn back to the outlook, are that we actually do have some borders opening from the start of next year. Now that was an underpinning assumption I didn't actually highlight earlier, but we're expecting that there'll be a, you know, go complete, you know, off to on. It'll be a gradual reopening, but we expect there will be some in that sort of time frame. We hope vaccinations sort of higher and probably some risk-based orientation, which countries are lower risk than others and whatever. We hope that the recovery is sustained and you know, what might have been a slight moderation in growth doesn't turn into a long sort of dreary or another recession, but hopefully we're back through in a place where businesses are starting to look ahead more with confidence and starting to invest in their future. And for a sector, obviously so some of those dynamic and competitive forces can start to play out a bit. I mean, the sector's done, as I've said before, a fantastic resilience job, kept alive through these difficult times, operated well. It's changed its ways of working. I know for many of you, those are becoming permanent. You know, that the in the office is not necessarily the norm anymore. We're working in multiple ways. I think we're going to see more of that. We'll be more through learning about how effective we are and what we can do, and online platforms working well. So yeah, I think it'd be an interesting and exciting time to be starting to sort of have a bit of not just a hold it together, but a go forward orientation, I suppose, is what I'm wanting to see more of, and not just be housing, but be more widespread.
And to think forward into the remainder of the year, or whatever this year might play out like. Richard, to your point, we have taken great value, and thank you very much for making this forum available to us over the last 12 months. We've derived value from it. I'm hoping that at the other end of the screens, people have seen value as well. In a perfect world, we'll all be able to get together and face-to-face with each other, and it's certainly our intention to run insurance sector industry events, senior management directors, that sort of thing, face-to-face. These webinars are outstandingly valuable, and we'd like to augment those through the coming year and going forward with wider industry events where we can actually look people in the eye and have them look us in the eye and actually talk about some of these things rather than talk at. So that's our intention. All other things being equal, of course, and we, despite the fact that we're regulators, we have no direct control over that. So I'm sure you'll understand that one.
Geoff, Richard, Adrian, Andy, Brendan, huge thank you on behalf of all of us. Really great questions came through from the floor. We appreciate everyone sending those through. I might hand over to Rob Flanagan if I can, Rob, just to say some closing comments, and then we'll wrap and wish everyone an excellent day. Rob, over to you.
Thank you. Thanks, Geoff and the team. We really appreciate you taking the time and giving the opportunity to all of us to hear it firsthand, and where the trends are. There seems to be sometimes a bit of a disconnect for what the media is saying and what is really happening, and it's appreciated to sort of get the right version of truth, shall we say. So that's, I think, very helpful to all of us. So thank you very, very much for taking the time and being very transparent and answering the questions that have been put forward. So hope you all have a good day, and thank you, everybody, for attending.